We're quite positive in terms of the outlook, and we think that you can lose that in terms of all the noise that we have had over the last year.
We are continuing to find lots of great ideas.
Where we're finding more incremental ideas is actually out of Europe. What we find interesting though is that the penetration levels of e-commerce vary vastly between different geographies.
We're currently seeing a generational shift in how payments occur, with the shift from cash and check towards digital and API-driven payment processes.
When we caught up, it was a really crazy time, and it's been a busy year. There's been a lot of headlines dominating the news flow around the pandemic, US election, stimulus in the market, and we just even more recently news on a potential vaccine. It's a lot of noise for people to get consumed in. I was wondering if you give me your take on what people have been overlooking, or what are people missing?
The case for optimism as we look forward. There has been an enormous amount of noise. There has been some doom and gloom associated with the pandemic. A lot of people have had a tough year. But as we look forward, we're very optimistic. We know a lot more about COVID. The US election is now passed, and the outcome, the setup looks quite positive for equities. And in terms of stimulus, we've got governments that are very supportive, central banks that are incredibly supportive. And so we're quite positive in terms of the outlook. And we think that you can lose that in terms of all the noise that we have had over the last year.
If you shift that to the portfolio, how have you moved things around to capture some of that optimistic view that you've got?
So initially, we focused on liquidity and bought a number of the larger cap names that had really been sold off. As we've gone through the reopening of economies, and a lot of the share prices of some of those larger cap stocks have done exceptionally well. We have been agile, and we have taken advantages of disconnects in valuation, and have found a lot more opportunities in the small and mid cap end of the market. From a geographic perspective, we had a very heavy weighting in the US, and we still love a lot of the businesses that we own in the US. But where we're finding more incremental ideas is actually out of Europe, and we find that a lot of the valuations there aren't as extreme as the US, but we can still find businesses that are growing fantastically, that have very high quality management teams, and are potentially earlier on in terms of some of those structural trends that are occurring through the rest of the world.
Yeah, and I think in a year like this, it's brought home the importance of the ability to have that flexible view on the world, and to be able to step back and to look where the opportunities exist, whether it's small to mid caps, whether it's in Europe, but it's continuing to stick to that process. Great businesses, but we're just looking for those great businesses at very attractive prices.
So when we caught up in May, you talked about a couple of themes that you were looking to put into the portfolio: e-commerce, digital payments, which we know have been strong. And you also introduced the concept of thrifty stores, which was an interesting one for the time. Are they still in the portfolio, and how have they played out?
In times of uncertainty, people tend to tighten their belts, and so we had that thematic that we liked, and we played that thematic through a number of names around the world. For example, in the US, we owned the largest dollar stores operator, Dollar General. In Japan, a discount retailer called Kobe Busan, and in Europe, a discount store operator called B&M Value Retail. And what we've seen is that the consumer has tightened their belt. We had a lot of those stores remained open, and so they were massive beneficiaries of other places where you could shop not being open. We have reduced some of the positions in those stocks just because they've done well, but we do think there is still uncertainty in the world. We are more optimistic on the outlook, but we still like the thematic, and what we liked about those individual businesses was that they had store rollouts themselves. They had really high quality management teams, and their valuations were really compelling. So still like them.
We very much believe in digital payments having longevity to the theme. We're currently seeing a generational shift in how payments occur, with the shift from cash and check towards digital and API-driven payment processes. It's been 10 plus years of a shift to digital payments, but cash remains an $18 trillion opportunity globally. And even over that time frame, the amount of cash transactions has actually grown. So a lot of reasons on our behalf to think that the digital payments thematic has a lot of runway left to go. Now we play that space, and we play it through names like Fiserv and FIS, amongst others within the portfolio.
With these structural themes, it seems like everyone's on the trade. So it can continue, I believe that, but where's the value?
Most companies in the space, if they trade on a PE at all, it's north of 100 times, which it's not where we like to hunt traditionally. So what we've done is we've found companies that trade on 20 times, 22 times PE.
And then on e-commerce, you see the tailwinds continue to support that opportunity?
Yeah, we think we've seen an acceleration in a trend that was already there. Companies in playing in the home and furnishings area in Germany, Home24 and Westwing are two names listed in Germany, trading on fractions of the peers globally, and yet with an enormous runway ahead. The German market, for example, in home and furnishings is at that 8 to 10% penetration level, was 6 or 7 pre-COVID, and yet UK and US, well north of 20. So those companies trade. Wayfair is the peer in the US. Trades, has a market cap of 24 billion. These are the 400, 500 mil market cap euro level, and yet have growing at the same level, net cash balance sheet, management teams well incentivized, well aligned, and margins that are actually already better than their US peer.
And so outside of those three thematics, what are some of the other ideas that are in the portfolio? One
would be the cloud. It's well discussed and well known, but through COVID we've all been forced to migrate. Whether it's us having with our travel, we do. At the moment we're doing all our international company meetings via Zoom and Teams, etc. And yet we're very early days in terms of transitioning onto the cloud. If you look across the world, I think 50% of dollars are still spent on premise, and so we think there's a significant longevity in that transition, and there has been some pull forward. So you had the Microsoft CEO talking earlier in COVID about 2 years demand being pulled forward into 2 months, but that weight of dollars is still significant in terms of on-prem versus off. So we're excited about opportunities there still.
And Nick, is there anything else that you've been doing some work on?
Healthcare as a trend has a lot of longevity to it. Demographics are also a significant tailwind here, where in the US at least by 2030 the old will outnumber the young. So 1 in 5 individuals will be over 65. And it's a truism in healthcare that you spend more as you age. So there's a couple of strong tailwinds behind the healthcare thematic. We play healthcare through a number of names in the fund, but in particular, Avantor and Thermo Fisher are great support companies to those companies doing the pharmaceutical research and development. They're not exposed to FDA approvals. They won't be a disappointment if a drug doesn't pass a phase 3 trial, but they're set to benefit from these really strong long-term tailwinds that are in healthcare.
Where are you seeing some compelling value? Talk me through a story that you're really passionate about.
Yeah, absolutely. So one I'd love to talk through is Avantor, who are kind of a life sciences and tools company. Now they've done very well, so they're in the mid-cap category at this point, but certainly not in the large cap like some of their peers in that space. And what they do is they both produce and distribute consumables and equipment to the pharmaceutical, the industrial, and the government and academic end markets. And what we really like a lot about the stock, there are 3 things in particular that we think makes it a great name to hold right now. The first is that 50% of the company is driven by biopharma as an end market. And biopharma's doing phenomenally well right now. The funding levels are at record highs and they kind of future-proof the next few years. And the innovations that are being achieved in that space in oncology and orphan drugs, and even with the vaccines for COVID, they're actually a big player there as well.
How have you changed the way that the overall portfolio looks from a geographic and a market cap position?
In places like Europe, for example, we can find a number of names that we think are really interesting, and then in particular down the market cap, we think we're seeing lots of interesting companies in the small mid cap end of the market. If you look at the the valuations versus historic norms, they're about average, where they have traded over time, whereas in that large cap growth end of the market, they're well above historic norms. So yeah, we're finding lots of interesting, exciting opportunities there.
How are the two of you thinking about opportunities that come from, a reopening of economies?
We've found a number of businesses that we think are really interesting from an opening up perspective. So, for example, in Germany again, we own an outdoor media business called Stroher, which is, does digital billboards. They have 60% market share in outdoor billboards across Germany. They have a really high quality management team that's highly aligned. So the two founders own 40% of the stock, and one of them is still the current CEO. They did some deals years ago that we think have created some very interesting assets that will over time be where value will be realised over time. So yeah, that's an example of a stock which has been the earnings and the revenues and the earnings have been hit through COVID as advertising was stopped. But it's a business with a fantastic industry position. It will survive and has a management team highly aligned to you. So we think it's very well placed as we reopen. So that's an example of stock we have looked at. Earlier on in the as we came out of the pandemic, we thought domestic travel relative to international travel was obviously going to rebound more quickly. So we looked at names, for example, in France, we owned a position in the largest caravan RV player in Europe called Trigano. So we thought that was an interesting company because they were a leading player in the European market. Clearly, people still are itching to travel, but they can't go far. And it had, net cash balance sheet, and we rate the management team there, and again a founding family with a lot of stock. So yeah, we played that earlier on, and then now we think we're more into those deeper hit line of fire stocks that are probably going to have the most potential to re-rate here. But that's for us, that's a portion of the portfolio, but at the same time, we have a lot of these longer dated thematic stocks that we think can benefit looking out 5-10 years.
Final question for shareholders. We asked you for a bit of a message for them at the end of our May Vault update. Have you got a message for shareholders at the moment?
It's obviously been a really hard year, but I think what can get mixed with all the media announcements and there can be a lot of doom and gloom presented around the risks and the downsides of coronavirus but I think if we take a step back, we're relatively optimistic about the coming period. And we can find we're not struggling to find new ideas and find companies that we want to invest in. So yeah, we value their support, very grateful for it, and are relatively optimistic about the period ahead.